Before has there been as much money as there is today, and rarely has money been so cheap, and yet the central banks continue to pump money into the world. We're being flooded by trillions of dollars and euros.
It can't go on forever. It's a ticking time bomb.
It's never been easier for investors to get their hands on cheap money. Running up debts is practically free of charge.
Organisations are just borrowing large amounts of money from each other and then using that to make money by lending it to others who are using that to lend it to others.
A snowball system that lets the rich become even richer. Savers, on the other hand, are losing billions every year thanks to low interest rates.
If you just open a savings account, it's almost like burning money.
This deluge of money has created deals worth billions. Companies are bought and sold for vast sums because loans are cheap. The employees become the pawns of the speculators.
The question is, where's all this money going?
We're in Bad Bodendorf in western Germany. This couple faces the same dilemma as many others. What to do with their savings in this world of low interest rates? Karl-Heinz Eich, a recently retired court bailiff, knows all about money and debts. His life insurance policy is due to pay out soon. How should he invest the money? In a house? They've already got one. There's a lot at stake for the cycling enthusiast. He and his wife want security in old age, as well as a good time.
I was hoping that after the payout, I'd be able to invest the money again and earn interest, which could be added to our pension. But that plan isn't going to work out.
Karl-Heinz has always led a modest life. He always stayed away from investments that paid high returns but were risky. He never thought it would come to this. He doesn't know what to do with interest rates this low, and nor do his friends.
Some have told me they won't keep their money in a bank account anymore. Instead, they'll deposit it as physical cash in a safe.
It's barely worth going to the bank. Interest on savings is almost zero, at just 0.01%. That means that he gets 1 cent for every 100 euros per year. What's happening with his money? People are worried, says the director of the local branch of Volksbank, Elmar Schmitz. Although there hasn't been a run on the safe deposit boxes yet, there have been more requests to keep money in cash or gold.
We've seen a continuing fall in interest rates over the past 8 years. I'd need a crystal ball to tell you whether it'll stay like this for long. I think we'll have this situation for another 2 or 3 years. After that, things will change again. But we won't have the interest rates we had 10 or 20 years ago.
The manager knows who he blames for these low interest rates: the European Central Bank. The remit of the ECB is clear: price stability. It uses the base rate as its tool to deliver that, and it's been lowering the base rate steadily ever since the financial crisis, down to zero. Savers are left by the wayside, but countries with high levels of debt, such as Greece, are able to get their hands on cheap money. So too can ailing banks in southern Europe. The cheap money is supposed to fuel growth. By buying government bonds, the ECB has pumped additional trillions of euros into the markets. Otherwise, the system would face potential collapse. The price of all this is a deluge of money. The money has to go somewhere, into shares and real estate, which continue to rise in price. The result is a massive concentration of wealth right at the top. Bill Gates, the world's richest man, has a fortune of 65 billion euros. That's the market value of his shares. To compare, the total value of all of the world's cash is less than 100 times that amount, 5 trillion euros. The value of all goods and services created every year around the world is 75 trillion euros. That's the real economy. The world's debts are far higher than that. States, businesses and private individuals all have debts. A world living on credit. 705 trillion, that's the value of all derivatives, the speculative financial bets on the future. They've got almost nothing to do with real goods anymore. To recap, this is the fortune of Bill Gates. What happens when there's too much money in the world? Economist Max Otter says this deluge of cheap money isn't just flooding the big banks. He sees low interest rates as the symptom of a massive sickness in the global financial system. What's more, cheap money endangers the entire economy and promotes increasing levels of debt. He says those who believe that with the financial crisis of 2008 receding, things are now better again are much mistaken.
This influx of money is extremely dangerous. It's slow, but at some point the dam will burst and then we'll be in a huge crisis.
The biggest danger is that this flood of cheap money will split our society. It moves money from the bottom upwards, he says. A gigantic redistribution machine.
Low interest rates are demanded by many economists. They mean that states can borrow on the cheap. States can take on more debt. It also means the rich can do the same and often without any liability if they default. If I, as one of the super rich, buy a business, then I'm only liable to the extent of my holding, not with the rest of my wealth. That's a blatant injustice compared to middle-class families and regular people with home construction loans.
This flood of money doesn't just save states and banks, it also favors the rich, who use this cheap money to buy shares, companies and real estate with rapidly rising values, while the financial investments of ordinary people lose value.
The middle classes have savings and insurance policies, and these investments are the losers in a low interest rate world. Poorer citizens suffer because real estate prices are going up and therefore rents too.
London, the world's largest financial centre, illustrates very clearly the effect of this monetary deluge. Trillions are traded here. 300,000 employees in the financial sector are trying to turn money into even more money. London's own real estate prices are skyrocketing. All the major banks have offices here. This is where the money of the world's rich is invested. Roman Borisovich knows the scene well. There are neighbourhoods where millionaires are being pushed out by billionaires. Borisovich is fighting against a sell-off of the City of London to speculators. Together with colleagues, he has researched the anonymous owners of several properties. As a former banker, he's familiar with price developments.
Well, these are used houses, and again, depending on the size, it's difficult to say how deep they are. But anywhere between 3 to 5, maybe 5 to 7 million in this particular area, 5 to 7 million pounds. Now, if you think about Muse houses, this is a family place. Just think about what kind of family can afford to buy a house for 3 to 5, even for 5 to 7 million pounds.
The expensive houses are all speculative objects and empty. London belongs to investors who don't live in the city. Roman Borisovich discovered that this townhouse was sold to a Ukrainian billionaire for £66 million. On paper, the mansion is owned by a shell company.
Right now, there is an excess of 40,000 properties in London that are owned by anonymous offshore corporations, meaning that we don't know who the owners are. They could be decent people, they could be mafia. Therefore, we suspect that a lot of this money that came through London, that exploded prices here, is actually of dirty origin.
There's construction underway everywhere. Speculating with real estate is the big game in town. Trillions of euros from Russians, Germans, Chinese and Indians have poured into London.
From socio-economic perspective, it is not sustainable. You cannot have a city where residents and workers cannot live. You know, this is the problem with bubbles, is that nobody knows when they're going to burst.
But London doesn't have a monopoly on real estate bubbles. They now exist in cities around the world.
If a real estate bubble were to burst, sure, it would hit the wealthy who are invested there. But they have a diverse investment portfolio. They seize opportunities around the world. If the real estate bubble in Munich were to burst, they'll be in Rio or Tokyo. They can act globally, but the middle class can't.
As seen in the financial crisis of 2008, the middle class is hit while the rich get richer in times of boom and bust. Not much has changed. The minor regulations introduced into the financial sector aren't very tangible here in London. The speculators are looking for new ways to make more money in the world's #1 financial centre. Many transactions are now taking place in the shadow banking system. The bonuses for lucrative deals are as plentiful as ever. And Brexit will see the regulations relaxed even further. The show must go on. Alf Townsend has lived through it all. He's been driving a taxi for 54 years, chauffeuring bankers and brokers around the city. Dealing in the world's trillions has become the trump card of the British economy, he says optimistically.
It's beneficial to London. I think it's various people who invest whatever part of the world they come from. If they want to invest their money in the city, that's good for the British economy, yeah?
He too has profited, but in exchange Alf has to live far outside the city centre. £1 million for a single-room apartment? No ordinary local can afford that.
There's not many Londoners, apart from us old people, who still live in London. Most of them have sold their houses, as I was saying earlier, bought their houses off the council, made a fat profit, sold it, and moved out to a suburban hideaway, yeah?
Some leave the city entirely, and forever. Geraint Anderson was one of London's financial stars. He now lives in Wales. He paid the same for his farm as he would have to pay for a tiny single-room apartment in downtown London. But that's not the only reason why he came here. He's had enough of the financial excesses.
The city is full of greedy, ruthless, clever people. And if they put a bit more regulation, a little bit more compliance, some restrictions, these guys work out how to game the system to make sure that it benefits them.
Today he writes novels and screenplays about the financial world. He used to earn a few £100,000 a year. He didn't care who the trades hurt. That's a few years ago now. But nothing has changed, says Anderson. The system rewards those who make fat deals at the expense of others.
I make lots of strange gambles, incredible reckless decisions, but they come good, then I make huge amounts of money. If they go bad, maybe I lose my job, but that's the only downside. So this is what is called an asymmetrical risk. It encourages short-term gambling.
Anderson is certain that the financial system will keep growing and sprawling. The prospects of big profits, the low interest rates, the deluge of money. The former financial insider believes these elements make for an explosive mix.
Therapeutic. The Ponzi system that exists is such that organizations are just borrowing large amounts of money from each other and then using that to make money by lending it to others who are using that to lend it to others, which means that you have a system where ultimately no one's really got the money that backs up all the money that's being lent out. And subsequently, when that system comes crashing down, then it's good night.
A tax on speculative financial transactions could slow this merry-go-round. However, this financial transactions tax would need to be introduced globally. But even the small-scale version with just 10 EU states failed after years of negotiations, even though German Finance Minister Wolfgang Schäuble personally pushed for this tax. But Britain was against it, and will be even more against it in the future. London as a financial centre would suffer. That's most regrettable, because this tax would be the necessary surgery for the sick financial system. The ECB and other central banks flooding the world with cheap money isn't a cure. It's just pain relief, and in the long run, it has serious side effects. The entire setup is a system that keeps saving itself temporarily, but at some point it will inevitably fall apart. Until then, it exacerbates the enormous injustice that already exists. Those who have benefit. A handful of super-rich individuals own as much as the poorer half of the world's population combined. This flood of money is increasing the gap between rich and poor even further. People like these are struggling at the hands of low interest rates. Karl-Heinz Eich and his friends are worried. In the past, the world was a veritable paradise for savers. The economy was booming and interest rates were high, even if inflation was too. Nevertheless, successive generations lived by the motto, those who save get more out of life.
In the past, you could rely on a certain interest rate for your savings account. You could live with that. But not anymore.
In the 70s, we got a fixed rate of 7%. For a short while, we got 11%.
Karl-Heinz Eich has an appointment with his financial advisor at the bank. What should he do with his money?